This is another episode of me trading smart, managing risk while learning how to trade effectively. And if I do all three of those things on a day to day basis, consistently, without failure, millions and millions of dollars will yield as a result. And today marked the end of my first week of actually following a model, actually following an approach to the market since I started trading ICT concepts. And I did not bad, not bad at all. Let's look at the stats. Check this out. So today I executed 10 trades. I started actually following my model, my approach on Tuesday. Monday I did a volatility pinball drill, so I will not count that because that's not me following a model or anything. That's me just throwing trades out there, right? But on Tuesday I was like, okay, I know what I'm looking for now. Let's follow it. And these are the results. My first week, I took 10 trades. I got 7 incorrect and 3 correct. So I had a 30% win rate, but I was still able to run up the account by 0.5%. So I'm trading on a 100K account on a demo, and the account balance out to this week is $100,595 excluding commissions. So let's say we factor in the commission costs. It's probably up 5%, 0.5%, maybe less, not 5%. So not bad for my first week's trading, right? Actually following my approach and my model, which is, I mean, it's crazy. If you've been following my journey, you can see that I'm progressing at, I would argue, a pretty fast rate. And it's just very encouraging to see my progress, and also very encouraging to see that you all can see my progress as well. Those of you who are just staying tuned with my journey because you're just intrigued and you're commenting down below, supporting the journey. Thank you for that. I love that. That just gives me more fuel, more motivation to continue working at this shit literally every single day, all day. And I know that you can do the same, okay? If I can make this shit work, there's no reason why you can't make it work. So to all those who are on the same journey as me, I mean, we fucking got this. We got this shit in the bag, right? As long as we consistently show up to the market every single day, as long as we be avid journalers, we learn from all the mistakes that we make. Being a consistently profitable trader is very attainable, okay? We can all make this shit work. I mean, I'd like to argue that it is hard not to be profitable trading ICT concepts. I had a 30% win rate this week. I was still able to come out on top 0.5% in my very first week following my model. So that's just the ICT effect, I guess you could call it. All right. And before we get into this video any further, I'd like to shout out my Discord community. It is titled Vision Traders. Why? Because we are traders with a vision. We have a vision of what trading will yield for us, a fruitful life that is going to yield for us, right? So if you would like to be a part of this community, we're all in here. We're talking on a day-to-day basis. We're helping each other. We're growing together. We're getting better. We're sharing our lessons. We're sharing our resources, our notes, our templates. I'm going to add a psychology category. If you would like to be a part of this community, the link is in my bio. But if you do not engage in the community, I will kick you because I want to make it a small, tight-knit circle of traders, okay? So it's free, absolutely free. I'm not charging anything for this, of course. If you'd like to be a part of this, feel free to join, but I would like you to engage. If you don't engage, I will kick you, okay? Small, tight-knit circle. We are all growing together. And it's awesome seeing a lot of the traders in here develop. Like, I'm seeing people get better, and we're all just growing together. We're all helping each other out. It's just fucking awesome. So if you want to be a part of this community, please feel free to join. I'd love to have you. And now we can get started. But first, water break. All right, cool. So, see my execution right here. I did have a losing trade today, and let's get into that, okay? So, daily time frame. Let's just start top down, because why not? Okay, so clearly, starting on the daily time frame, we have a classic bi-week profile. Notice how Monday we have a down close candle. Monday trades lower, builds that wick on the weekly candle, not the daily candle, on the weekly candle, right? Tuesday manipulates Monday's low, trades into the upper quadrant of this weekly buy side imbalance, sell side inefficiency, also trading off of the weekly discount wick lower quadrant. So if we go up to the weekly time frame, we can see we have that buy side imbalance, sell side inefficiency. If we grade this wick right here, we drop quadrants on that. We treat wicks as inefficiencies. We can see that we're working off the lower quadrant right there, right? Also in the upper portion of that weekly buy side imbalance, sell side inefficiency, which is exactly what you want to see because we traded into the lower half here. So if we are to return to this imbalance, we don't want to see it trade back to the lower half. And we don't see that. We see it respect the upper quadrant. So perfect, good reaction. Daily time frame. It is Friday, right? So what can we usually expect on our Friday? Well, we can expect a 20 to 30% retracement back into the weekly range. That is a TGIF. Thank God it is Friday, right? If we have a one-sided expansion move throughout the week, we can anticipate a 20 to 30% retracement back into the weekly range on Friday. And today we actually did get that. And I use that to frame my analysis today. So you simply drop a fib from the lowest low to the highest high of the week, which I have here. And you can see these levels right here, 02 and 03, that's 20%, 30% retracement. And look where the low day forms in today's session, right? Just under that 30% retracement level. So that's probably random. I don't know. And I'm also grading the daily discount wick and the daily premium wick as well to grade the relative strength and weakness of the marketplace. Those are also very important levels that's going to give us key insights into what price action could possibly do today. Okay. Daily time frame, cool. Dropping down to the 15-minute. I think my read on the market was pretty easy today and pretty straightforward. If we look at this chart, what is obvious, what stands out to you? Well, we have this large discount wick right here, right? And if we go to the hourly time frame, turn these off for now. Apply to all, there we go. If we go to the hourly time frame, I'm grading this wick, right? Because we treat wicks as inefficiencies, meaning we treat them like they are a fair value gap. So we do have the primary sell side liquidity here, right? At Thursday's daily low, but in order to get to this pool of sell side liquidity, price has to overcome this wick, which we would treat as an inefficiency. So that could be an impediment for price reaching that daily low. So you want to grade this, right? Because that's going to give you information that's going to allow you to grade the relative strength and weakness of the market. So I drop a fib on that, finding consequent encroachment, and look where the lower day forms today, right? It's respecting that wick. Trades down into the lower quadrant. I bet if we find our quadrants on this, oh, that's probably random. Wow, look at that. So we can see how we reacted off the lower quadrant of that. Let's just drop that on there while we're here. Why not? Right there. Just leave that on there. Cool. Yeah, I don't know why the market would ever do that. It's probably random. So back to the 15-minute time frame. No, it didn't show 15-minute. Gotta change the visibility on that. There we go. Down to 15. Cool. So yeah, that's where the lower day forms. Again, that's I don't know why the fuck the market would ever do that. It's kind of cool, but I'm using the consequent encroachment of this wick to grade the relative strength and weakness of the marketplace. Now, this level also aligns up with a 30% retracement back into the weekly range, which is also probably random. I don't know how those would ever line up together. I don't know. It's crazy. But yeah, we have the consequent encroachment of the discount wick as well as a 30% retracement on the weekly range aligning in this one area of price action, right? These two areas are converging. So I want to gauge how the market reacts to these price levels. And in the overnight session, we can clearly see we have what? The start of a market maker buy model. How do we know that? Well, we have an original consolidation here, right? Here's our perfect little box of price action. Highlight that. Cool. Don't extend it, right? There we go. Original box of price action, right? That perfect little box of consolidation, perfect little range, right? What do we do? Initially, we see protraction lower. We take sell side liquidity first. So what's it going to do next? Take the buy side liquidity. Takes one side of the range, later on defers to the other side. Pretty simple logic. Is that complicated? No, it's not complicated. So stop leaving me comments telling me that it's complicated, because it's not. Okay, you just have to put in the work and really understand this shit. Do a couple months of your own work and things will start to click. Okay. Original consolidation, drop down, take the sell side liquidity first, and then we have buy side liquidity resting above these very smooth equal highs. So if we extend this price line out in time, so this pool of liquidity also lines up with that premium wick on the daily chart, which is also probably random, right? So we have relatively equal highs. Notice how this high does not take this high, leaves these highs intact as well as this high. So we know that there's buy stops resting above these highs, and the algorithm is going to seek that liquidity, right? And what do we do at the 8:30 news driver? We have PPI. Okay, news is a smokescreen. It is used to hide the true intentions of what the market makers want to do with price. So what do we see price do at the news driver? Well, initially it trades lower and takes sell side liquidity. Okay, if they aim for the sell side liquidity first, what is next? Buy side liquidity. Is that hard? No, that's not hard, and it's not complicated. It's pretty easy. It's pretty simple logic. If we look below the marketplace, we can see that the stops are ran below all these smooth lows. Look at all these relatively equal lows down here, right? 8:30 news driver initially this thing drops down, takes the sell side liquidity below these relative equal lows. We drop down initially, protraction lower, take the sell side liquidity first. So what's next? Well, it's going to go take the buy side liquidity above where? Well, we have these smooth highs above the marketplace. We also have new day opening gaps in close proximity together. They're basically layered, right? So that's also going to be a strong draw on liquidity. And what else do we have? We have a discount gap opening. If you notice where we closed yesterday at 4:15 p.m. and where we opened today at 9:30, we have a gap down. If you toggle this setting in the bottom right corner, electronic trading hours and regular trading hours, regular trading hours ends at 4:15 p.m. and starts the following day, the next session at 9:30 in the morning. Electronic trading hours goes through the entire 23/6 schedule, and it includes the overnight session data, right? That's why we see this. But if you toggle that setting, you notice that we have a discount gap opening, meaning we gap down from where we closed yesterday, right? So what does that do? That establishes our initial bias in the first half hour market open in that opening range. We have a bullish bias. Why? Because we gapped down from yesterday's gap opening, okay? We have a discount gap opening. And there's a 70% likelihood that the market's going to trade to consequent encroachment of that opening range gap in the first half hour of market open. Does it do so? Yeah. That's also probably random, right? We delivered to that on the 10 a.m. candle. But if we see what time it delivers, well, we had that news driver at 10 o'clock and it didn't deliver to that after. So it did not deliver in that first half hour. It delivered slightly after, but still delivered at 10:06, right? So shortly after. And then we had a gap fill around 10:11. So that opening range gap is going to establish your initial bias for the first half hour market open, okay? So using all this information, putting all these pieces together, let's run through them real quick. Relative equal highs above, original consolidation, initially dropped down, protraction lower. We have a discount gap opening. We have this area of price action where we see the consequent encroachment of a higher time frame discount wick aligned with a 30% retracement on the weekly range. The news driver initially trades lower and aims for sell side liquidity first, leaving smooth highs above the marketplace. Put all those things together, and the overall higher time frame order flow is bullish. We've been bullish for this entire week, right? Literally, the bias has been bullish coming into every single session except Monday, right? And Monday we dropped down. Literally every other day this week we've seen price distribute higher after the 9:30 open. So put all those pieces together, and there you have your bias. So that was I was looking for higher prices post 9:30, using all those informations, putting all those pieces of the puzzle together. So drop down to the lower time frame, and let's talk about where I went wrong today. So where I simply went wrong is, oh wait, before we get into the execution, we also had an SMT divergence. So let's just look at that real quick, right? If we look at this low down here, we can see that YM and ES are literally just off to the races, right? Exploding higher. But look what NQ is doing. NQ is taking that 445 low. So we have an SMT divergence there. That's another piece of the puzzle. You have all these factors coming together telling you, yo, I want to go higher. So what do? Look for a long, okay? Now, where I went wrong was I did not know there was a 8:30 news, not 8:30, 10 o'clock news driver. Very, very simple mistake. So I knew that we had 8:30 PPI, red folder, high impact news, right? Initially dropped down, took the sell side first. Well, we also had a 10 o'clock consumer sentiment and inflation expectations, whatever that is. The data doesn't matter. We just have to know that there's a news event at that time because there's going to be an injection of volatility. Now, I was unaware of this. Somehow, I don't really know how. Is my camera good? I think we're good. Yeah. Somehow, I didn't know that we had this consumer sentiment news report. So I traded before it. Now, had I known that there was that consumer sentiment news report, I would have waited 10 o'clock, let that thing come out, and then see what the market presents me. But I didn't know that that was there. And initially at 9:30 open, I identified the market as high resistance to liquidity conditions because if we drop down to the 15-second time frame and we look at the first presented fair value gap, we can see, which is right here, that first fair value gap after 9:30 on the 15-second time frame. Notice how many times price refers back to it. Price should not spend that much time inside of an imbalance that has a lot of influence on the daily range, right? And if price is behaving this way, we automatically know price is in high resistance liquidity conditions, and it's going to be challenging conditions to engage the marketplace. It's really going to be conditions that I don't want to participate in it at all. So I instantly picked up on these conditions. I told myself, yep, this is not it. I'm not trading these conditions, right? I'm showing discipline. I'm showing self-control to stay out of the marketplace because yes, it's moving, but these are simply not conditions that I want to engage in because they're challenging. So what is my protocol? I want to wait for the first element of time after 9:30, which is that 9:50 macro. And if we see how price behaves during the 9:50 macro, we see that we spend a lot of time in this inefficiency right here. So what is that indicative of? High resistance liquidity conditions, right? But as soon as I see this displacement out of the inversion fair value gap, right? Initially, we just kind of slowly crawl through it, and then this candle opens, it trades down into it, and then I see displacement up out of it. So I see that reaction of the inversion fair value gap, and I'm thinking, okay, this thing is going higher. I set a very low threshold target, just literally just targeting the midpoint of that opening range gap because I thought we were just going to boop, work right off of that, and then get sent higher because at this point the order flow is clearly bullish. On the 15-minute time frame, I was monitoring how we were respecting this area price action. Notice how the body of the candle closes above it, right? So what does that indicate? Strength. Look what this candle does too. Drops down right into it. That's probably random. So it closes above it right here. Previous candle starts expanding higher. If I go to the 5-minute, this is just something that I've noticed in price action that tends to lead to reversals if we have a large down close candle into a pool of liquidity or a higher time frame point of interest or higher time frame PD rate, anything like that. Displacement lower, but then immediate displacement back into the range that usually leads to a reversal. And we kind of see the same thing right here, right? Displacement out, we run this short-term high and then displacement back into the range. So seeing this candle pattern, I guess you could call it, where we just displace out but immediately displace back in, that usually leads to reversals. And I think I saw the same thing yesterday that signified a reversal, which was right here. I was tape reading this move. It never came back and gave me my fill. But notice how we displaced down out of the range, tagging all this sell side liquidity, right? Closes below it. So we know the damage is done. We know the stops are ran and displaces back into the range. So that's just a little candlestick pattern that I typically see when we have reversals, right? And it happens here and here. So cool. Doesn't happen every time, but usually when I see it, it tends to lead to reversal, right? And this literally marked the low of the day. And it's working off the lower quadrant of that wick on the hourly time frame. Okay. Now dropping back down to the 15-second, so I can show y'all what I use to get long. So I like the displacement off of the inversion fair value gap. We have an imbalance here, no imbalance here. Take out a short-term high. So I'm simply getting long on this fair value gap right here, targeting the consequent encroachment of that. So just literally just a 20 handle move with a stop loss below this swing low, right? Yep. Stop loss below these relative equal lows right here. Now the problem with this trade is I'm getting way too, well, number one, I already outlined the very first mistake. I am trading right ahead of that news driver. I should wait for that news driver to come out, then look to take a trade, right? Well, another problem with this trade is I am literally getting long right after the market tags a pool of buy-side liquidity. So if I get an entry here with the stop loss below here, that's not high probability. Why? Because after tagging this pool of buy-side liquidity, it's likely that we will see a deeper retracement down into a deeper discount before we continue higher. Even if this were to play out, this probably still would have stopped me out because we just tagged this pool of buy-side liquidity, so we'd probably trade into internal range liquidity, such as if there was any imbalance left there, which in this case there wasn't, or we trade back down into an order block, something like that, internal range liquidity, and then make our way to the midpoint of that opening range gap. So anytime that I take an entry, it's the same thing to the downside as well. Like say I was trying to get short in this fair value gap right here, right? Well, the market just tagged the sell side liquidity below this low, so it's likely that we're going to see a deeper retracement, even if this thing were to continue lower, right? Because we don't see acceleration through that high. The market literally comes up to that high, barely dips its toe into that pool of buy side, and then we see it drop down back into the range. There's no acceleration through this high, so that's indicative that we will likely see a deeper retracement back into the range. So that's my second mistake there. First mistake, trading before the news driver. Second mistake was simply literally longing the market as it tags a pool of buy side liquidity, right? Not a probable trade at all. And then we have that new driver, drops down into the first presented for value gap on the 1 minute time frame again. And yeah, another thing that I used to frame that trade idea was how we reacted off the first presented for value gap right here. Boom. And then we started trading higher. And then I noticed the market was respecting down close candles. If you extend that open price out in time, respects that perfectly. Extend this open price out in time, respects that perfectly. So at this point, the order flow is bullish to me. We also have a 3 drives pattern where we have a low 1, 2, 3, right? We have 2 consecutive runs on liquidity. We run this low, and then boom, we start displacing higher. So we have a 3 drives pattern into that key level, that 30% retracement on the weekly range, as well as the consequent encroachment of that hourly discount wick and the lower quadrant. Look how we work off the lower quadrant. What, like, y'all are seeing this, right? This is the low of the day. That's probably random. Anyways, new driver comes out and then boom, distributes higher. So I saw some of the traders in the Discord take this trade today, right? Some of y'all were able to get on side with this. If you were, good shit, good stuff, good trading. We were out here robbing these fucking markets, so let's get it. And notice how we respect the upper quadrant of that breaker once we leave it, right? Wicks do the damage, trades down into the first potential for value gap, but look where the bodies are closing. They're closing in that upper quadrant, okay? So, obviously, just a crucial little mistake, but I'm exceptionally proud of myself because I was able to work on my psychological issues again. At 9:30, I felt a lot of self-control. Usually at 9:30, I feel anxiety. This time, I was calm and collected. I was being patient. I was sitting still. I was waiting until it made absolute sense to me. Now, this trade was not a high probability trade at all, and it kind of really didn't make sense to me at all. I also identified the challenging market conditions and still pushed the button. So, a bit of a mistake on my end there, but I stopped out on this trade and I handled that loss so well. I told myself, okay, that was my one pull of the trigger for this morning session. And then I saw the market play out in my favor afterwards. So obviously I wasn't able to get on side with that move. I'm not going to try to chase it. I sat here. I took that loss. I took that loss in the best possible way. Okay. I didn't sit here and think, oh man, I missed that move. Dang it, man. I knew it was going to go. I knew it was going to get there. Let me chase it, man. Let me get a part of this move, please. No, I'm sitting here. I'm being mature, right? I've reached a whole new point of mental maturity, and I'm thinking, bro, I'm so happy that the market played out exactly as I anticipated. Sure, I wasn't able to get up. Sure, I wasn't able to be a part of that move, but it literally delivered exactly as I anticipated. I'm not mad about that. I'm still happy. I'm still proud of myself for getting my analysis correct, for getting my draw on liquidity correct. I just made a simple few mistakes that I know I can learn from and use them to make me a better trader in the future. So yeah, in the future, I will be able to get on side with this move. Today, obviously wasn't because I had to learn those lessons, and those lessons will allow me to catch this move in the future, right? So it's reaching that point in mental maturity where you can really, really handle your losses and you understand the value that your losses bring and the insights that they reveal about you and the market. And you're not mad if you miss a move because the market still plays out in your favor. And you know that your setup's going to be there tomorrow and the day after that and the day after that and the day after that. And it's going to be there every single day at the same time. So you don't care. You literally don't care. It's that point of mental maturity. And it's just a sense of comfort knowing that I don't have to be in there chasing this damn thing because I know the same thing's gonna repeat next week 3 times at least minimum, right? It's just a feeling of confidence, and I was just so content with taking my one trade and stopping out and not making any money on it. I was totally fine with it, and that is something that I've never ever felt before. So I'm just reaching whole new levels of mental maturity. It's great. It's so great. I'm getting so much better. I'm getting so much better every single day. Literally every aspect of my trading, I'm getting so much better. Even on days where I don't even win, it doesn't even matter. I barely lost shit today. How much did I lose on this paper trading account? I lost $175 on that trade. The risk was so small. So I'm saying, guys, it's hard not to be profitable trading ICT if you actually do the due diligence to understand this shit. I'm telling you, put in the work and you can make this shit work too. That's it for this one. See ya.